I'm Kara Murphy, and this is Money with Murphy. With the S&P 500 down almost 20% from its peak in February, let's talk about volatile markets and when not to sell. Newly announced tariffs on goods from a wide range of our trading partners have increased the chances of recession and understandably have rattled markets. In addition to the S&P 500 falling sharply, the tech-heavy Nasdaq is down 23% from its December high, and credit spreads have blown out. Having been an investor through multiple bear markets, recessions, and even crashes, the panic currently gripping the markets feels familiar. But what I'm most reminded of is my grandfather and his experiences with investing. I share his story because I think it's a powerful example of how easy it can be to make an emotional investment decision that you might later regret. Orphaned at a young age, my grandfather bussed tables at a speakeasy in Manhattan. He hauled sacks of potatoes on a merchant sailing ship. Eventually, he became an accountant and remained ever stoic and no nonsense. Yet even these experiences and that knowledge were not enough to protect him from the emotional roller coaster of investing in the stock market. During his working years, he had invested modest amounts in stocks, and by the late 1980s, he had built a comfortable nest egg. 1982 to mid-1987 were particularly strong years, as the S&P 500 tripled in value. Then, on October 19th, 1987, or Black Monday, the S&P 500 plummeted over 22% in a single day. On the floor of the New York Stock Exchange, it was pure pandemonium. There were so many sell orders that the computers couldn't keep up. Trade requests sat in queues, ignored for minutes or even hours, a sacrilege delay on the trading floor, which led to more frustration and confusion. My father learned of the chaos later that night on the evening news. Sitting in his plush recliner with my grandmother by his side, he felt like he was watching his nest egg in his comfortable retirement just evaporate. He cursed himself for not having seen it coming. The next morning, over the Wall Street Journal, he frantically tallied up all his various stock holdings, ever the accountant, and calculated just how much he had lost. By the end of the day, he had called his broker and asked him to sell every single last share. He couldn't bear to have his future any more at risk. Back in his recliner that evening, he told my grandmother what he had done. She replied in her no-nonsense way, "Good, I'm tired of hearing you talk about it." And so Grandpa's stock investing experience came to an abrupt and unceremonious end. After a week like we've had, I think many people can relate to that feeling of just wanting out. But here's the important part of the story that can be too easy to forget: what my grandfather missed out on. From Black Monday through the next 10 years, the market had an unparalleled run, increasing by almost 4 times. In fact, it would have taken him just about a year to recoup what he had lost that fateful day. Instead, he lived another 30 years without a single stock to his name, kept comfortable by a generous pension, something that many of us today are not able to rely on. So if you're sitting in your recliner this evening, watching the scary headlines, and you just want out, please call your financial advisor. Discuss your goals and your portfolio. That's exactly what they're there for. And let the investment professionals navigate these rocky markets and ensure that you are on track to meet your financial goals. So until next time, invest wisely and live richly.